Yes, well, yeah,
Perfect.
we get going.
Mhm. Perfect. Thank you so much, everyone, for joining us today, especially in your lunch time, and especially Lawrence for joining us at your night time. So today we have Bill and Lawrence, both are Northeastern graduate. Bill graduated in 2024. He's graduate student, and Lawrence is BMSB graduate in 2019. Today, we're gonna have share them. They will gonna share us with their investment journey and their experience and their lesson learned. So thank you so much again for doing us for Northeastern. And I would like to Bill to introduce himself about his right now, what he's doing, and what is his experience.
Yeah, thank you, Hallie. So I am working on so I am a investor at Liquid Metal Ventures, and I'm the director of AI and robotics.
Mhm.
We are a private equity based in Boston, focusing in deep tech like AI, robotics, biomed, life science in general, and new energy. So we are focusing in three sectors, and my priority is to focus in AI and robotics, since my background is mostly in AI and robotics. I hold a bachelor degree from UPenn in computer science and math, and I did my data related works in Northeastern, and that's why I'm here. Well, it's great to be here with you all today and share some of my experience too. Thank you.
Thank you so much. Lawrence, will you share us your experience? And
Yeah, can you guys hear me?
yes, we can hear you.
Cool. So I'm Lawrence. You can call me. I can go by Mao. I was in with Northeastern. I guess started 10 years ago. And then I went to a fintech startup at Boston, and now I'm working for a venture capital firm. It's actually a French-based venture capital firm in Shanghai, so China. And what we're focusing on are really the consumer space plus technologies. And we've been, investing in China for over 20 years, and each year it generally generates really good returns consistently for our investors over the last 20 years. So in terms of the investment consistency, we are like ranked number one, among all the Asia VC funds in 2021 by preaching. So glad to be here, and I'm happy to discuss the topics with you guys and answer any questions.
Thank you so much again. So today we're going to discuss about the investment, both of their investment journeys, their lesson learned, and also in the last, after like 10 to 20 minutes, we're going to take Q&A. If you guys have any question, you can put in the chat box, and if it's related to the things which they are talking, we're going to take the questions in between. And let's start. So my first question is to Bill, that what criteria do you consider when you think about investment in any company?
Well, there are definitely a lot since we do majorly focus in deep tech, where we emphasize a lot on the technology itself. Like, what are the technical barriers? How many patents you have filed? What are something that you consider your competitors are not capable of and you are capable of? When we're looking to in our um, um, projects, we do want to see how many papers they have published as well. So this is definitely one of the major criteria we're looking to. I mean, this is definitely different from what Lawrence will share about because we look into deep tech and they look into consumer tech.
Mm-hmm.
Um, we also look into the team's profile since the team members we will interview them and see how can they lead the team in terms of leadership and how can they make their technology a technical profile into actual business models. This is something we do care about a lot as well. So these two things are what we are carefully focusing about.
Makes sense. Yes. What about you, Lawrence?
Yeah, I think Bill covered a lot. Just to add on, I think really if you talk about the criteria, it's really hard to define because it's really project agnostic, right? If it's a very technical project, you gotta be very technical focused. Like I was checking all the patents with one project,
Mm,
because they claim that their technology is so unique that nobody can do. But in fact, after you read all the patents, it's not a big
mm,
deal, right? But really, I think there's really no right criteria because you need to look at a bunch for different projects.
Mm-hmm.
Really, I think there are wrong ways to do it. Like if they hit this wall, they probably can't succeed, right? So I
Yeah.
think one good way to think about it is the opposite. Like there are no necessarily right ways to do it, but wrong ways. And to evaluate it, I think one interesting thing to think about is the product market fit. I guess we'll look at that a lot too. So really what the product market fit is basically telling you that, to have or launch a successful product, all you really need is first you have to have the market, right? If you know Eric Rice, like who was a Stanford guy. They got 50 guys, PhDs, Stanford PhDs, sitting there for 5 years, doing R&D for some really cool products.
Mm-hmm.
And then all of a sudden they figured out that nobody's actually paying for it. So literally they
Yeah.
wasted 5 years, and so the guy was putting up with the concept of lean startups, and really you gotta do MVP, right? The minimum variable product. Then you test with your customers and see if that resonates with your customers. And also really you have to evaluate the market if it's there, right? I think we have
Mm.
a lot. We will talk a lot about the market because for VCs the risks are so high that if a project can't generate significant amount of returns after a couple of years, you wouldn't even look at it because
Mm.
the risks are so high that you need really strong returns from one project. So I think product market fit really is a key or the prerequisite for us to keep looking, right? If the market is so small, you wouldn't even bother, even though they have fantastic technology, even if they have, absolutely killer team, right? So I think that's a prerequisite. And then,
Mm.
it comes down to, can they defend themselves from the competitors? Is there any, similar products? Are there any substitutes? And I think when it comes down to those, they are pretty, project agnostic, I would say. But
Mm-hmm.
I would say, putting product market fit upfront is a good starting point for you to, filter a lot of, unqualified projects for VCs. They may be really great business, but they are just not suitable for the VCs.
Mm-hmm.
That's just my quick thoughts about it.
Yeah, it's a great answer. Definitely. Market fit is so important. My question is to you is, can you share us your success story that uh, you were thinking like, I want to share with us your success story, and as well as you were thinking that this product will definitely work and it didn't work. So both of the stories I wanted to know from you.
Yeah, I guess I will share a very different story from like a typical VC story that they suddenly find that product or they are the only guy that trusted them, right? So I want to share a portfolio actually we invested, and it was quite a hit. So it was I guess the largest gay app in the world. So they got like 60 million users. In China, you can think of that's huge, right? And the problem with that company was, it cannot continue to grow. Like once it reaches, certain amount of users, right? Number of
Mm-hmm.
users. So
Mm-hmm.
really the success story comes from our exit strategy. So we exited immediately after it went IPO, when the price was high, and then we made some money. But for those who think they can make a better return after holding, or loses their money because the company pretty much dropped, the stock price pretty much dropped pretty fast after they missed their budgets. Because what I really want to share here is really the exit strategy. Because for the VCs, you can earn 10x, 20x, 100x on the paper, but only if you exit it, that number becomes a real profits, right?
Mm-hmm.
And if you do a little study on the IPO anomalies, meaning like the performance after IPO, after 3 years, all the companies listed in the US, 70% of them will be below the IPO price. That's a lot. Like that means like
Okay.
7 in 10 companies can't sustain their price when of their IPO price. And we particularly looked at those Chinese root companies when IPO in states. Although they're very similar to the US companies, but I have the data here that after 1 year 70% has already been lower than their original IPO price. So meaning you have to exit swiftly if you want to make some money at least after
Yeah.
it IPO, right? And if you look at and some may argue, hey, look, I got the best company, among those listed companies, like Chinese based listed companies in the States, right?
Mm-hmm.
So, and if you look at even the top 20 and look at them separately,
Mm-hmm.
only 5 of them will outperform S&P 500. And if you pull the rest 15, it's still relatively similar to the S&P 500 and still a little bit underperforming. So really knowing the opportunity cost, like even if you got the top 20, you still get 70% of the chances of not getting a good exit if you're
Yeah.
holding it so long. So that's a success story I want to share, is because
Mm-hmm.
it's not only you should invest in good companies or find or source scout those fantastic companies, but also you have to have a strong exit strategy. Otherwise, if you are get greedy or want to hold long, or you don't have a proper exit strategy, you can have partial exit, right? Like to
Yeah.
diversify risks. I'm not talking in details about those, but really people should think about the exit, because only exit can make your paper, return on paper become
Mm-hmm.
real. So that's a story I want to share, and might be interesting for those who just learned about the VC industry.
And,
It's quite different. So
and do you have any story in which you felt that this company will definitely rock and it didn't rock? Like you failed, like the company failed, that kind of thing you have happened
no,
to
I
you?
mean, if you look at the stats, 70% will drop. So we always feel like the companies will drop, like for the over 50% of chances, and eventually it is. It is. I mean, even though we generally can have 1.5 unicorns for every 10 companies we invest, the average was 1, but we still seeing those companies dropping over the time. Although some are doing really great, but still when you exit it, your fund is fine, right? So you don't need to be greedy about that extra
Yeah,
return to bear the risk of 70% going down below
so,
the IPO price.
so true. What about you, Bill? Do you have your success story?
Well, we are a relatively young fund, and I joined the fund in 2022. So our fund is actually 3 year old. So we don't have any realized income right now, meaning that we don't have any exit right now. But so far, all of our investments has proceeded to the next round or the round after the next round. So our book value did triple or quadruples, but that do not mean realized income, as Lawrence was just talking about. But
Yeah.
one of the most success story that I personally have is since we are hunting a lot of projects down in labs for Northeastern, Boston University, Harvard, MIT, Tufts, we do build up a lot of connections with the professors and APs. And one of like my closest friend received a investments from us as well as Sequoia and H16Z. And I found that a really successful story because it's out of my personal experience because I worked for that due diligence over the Christmas and New Year Eve, and it was really like working overtime. But we did manage to get in that round of investment, which were competed by all these very prestigious funds and well-known investors, and we somehow managed to snip into that round. And as a really young fund, I feel it really successful. And now they have already like their book value have already doubled after only 3 months because
Wow.
they have raised a second series round.
So as you shared with us that you are a young fund, so what is your risk assessment approach? Like,
So
mm-hmm.
yeah, that is a really good question. So our our thesis is that we found a gap for the major market average price and relatively minority founders. Most of us here today are minority founders. We are Asians, right? And we found the value assessments for these founders are particularly underevaluated in the market, in the current market, especially in the East Coast area. We found this really interesting, and the gap between the average um, evaluation and these founders are between are around 16%, which
Mm-hmm.
means that there are at least a 16% margin. Again, these are all unrealized margin, unrealized income, and also the success rate for minorities are somehow, well, it really depends, right? But it's somehow higher based on our statistics than the average. Well, for
Mm-hmm.
example, for MIT and Harvard, the Asian success rate, while saying success, we mean a successful product till Series C, not necessarily IPO, but Series
Mm-hmm.
C. We will define it as success because as very early stage funds, we can exit probably in Series B or C. But
Makes sense.
anyways,
Yeah.
the success rate is about 60% higher than average. So there is a gap there. That's our value proposition.
Mm-hmm. Lawrence.
And this is how we
Mm-hmm.
mitigate risk because we are sneaking into this margin, the gap between the market. And that's how we mitigate our risks.
Yeah, that's a great strategy. What about you, Lawrence? Do you have any risk assessment strategy which you follow, like your company follow?
For the strategies, I think it's generally, for instance, for the consumers, we are generally looking for brands because it's so easy to launch ideas in China, right? And also, I think similarly in the States, but it's so hard to sustain. It's so easy to produce, but so hard to establish a brand. But only with brands, you can make more money, you can have better impacts, you can get all those of crazy things, right? So I think that's a general thesis. And for tech, our thesis is really focusing on some, really niche or, strong use cases. And that will, generate, very, stable demand. It's not a nice have type of thing, right? It must be a must have. So,
Mm-hmm.
so that with regards to the thesis, I think that's it. But and we look through all the investments, all the deals, and try to compare and contrast, and try to find the best possible team or a couple possible teams to build a brand, for instance, in the consumer space. But
Mm-hmm.
again, it's really, I think, very, project agnostic. It's, generally the guidance is you got to have a brand, because that way you can sustain it.
Mm-hmm.
Otherwise, and for instance, if you think about, Coke, right? Uh, Coke can charge you, 10 cents more for everyone. People will probably be fine. But if it's, Jack's Coke, they probably can't charge you even a cent. So without a brand, you can't do all those things, and without a
Mm-hmm.
brand, you can't sustain. Although, even though Coke claim they have a secret formula, but people can mimic very similar tastes, although it's not
Mm.
identical, but they can produce, right? But the brand is the hard part. So really, we're looking for brands.
Yeah, makes sense. My next question would be like, if we talk about Northeastern, there are a lot of new entrepreneurs, right? In last 3, 4 years, there are a lot of new entrepreneurs came in North, like there are a lot of people who want to start their own business, right? This wave is going so strong. So do you feel change in the market that these things are changing and in future it will gonna impact this way? So what was in the past and what is different now, and what will be different in the future in terms of investment and coming new businesses in the market?
Yeah, I guess I can, chime in first. I think it might be not super relevant because we are based in China. So for Northeastern entrepreneurs, I'm not sure if it's super relevant. But I think the key here is not to think like great founders are generally have similar characteristics. For instance, like I think the number one is perseverance, right? So eventually the winners are not the smartest guy. It's really the one that really wants to get there. And if there's a war, they can dig some ditches and get there, right? If there's or they can climb through the wall, right? So the really you have to have the perseverance because it's so hard. If you think about it, it's so hard. You may experience a lot of failures. People may leave. There are a lot of voice of doubts, and you gotta persevere. Through the journey, and that's I think number one characteristic is that you have to have, and it's never changing, right? And also you gotta have a very good understanding, like some sort of a sense of genius. I think in that market. But with those two, you can be successful. But I think nowadays, when we look at founders, the perspectives are a little bit different from I'd say 70, 80 years ago. If you look at the States, originally after post World War II, those successful figures are generally have a really stylistic figure. They're like really extreme characters, right? So and then when it comes to like 80s, 90s, professionals are gets I mean these guys founders generally are getting more professional. Like they want to get listed, they want to go for the IPO. But so the sales and marketing has been picked up again. It's not only like extreme characters, but that made a lot of IPOs. So that kind of leads to the dot-com bubble, and then the tech CEOs comes into everyone's views, and you have Mark Zuckerberg. It's sort of the apotheosis of the tech founders, and really then it's sort of more technical nowadays, right? But I
Mm-hmm.
think really for the founders, aside from the perseverance and the genius side of it, I think the key is they gotta have, it's like a bucket effect. You can't have something that's you are not really good at, or
Mm-hmm.
your team can't have something that's you're really bad at, right? You should be good at the technical part, but also learn how to do the marketing and sales. And I think that would be a general advice I can give, because work on that will be super important, and try to practice perseverance, because it's a long journey, it's so hard. So but I'm not
Yeah.
sure if it's super relevant, just commenting from the very general level, because I guess we are more focused in China here. I guess Bill, you can comment
Yeah.
more on the US market. Yeah.
Yeah, thanks, Lawrence. Thanks, Helly, for the question. Yeah, honestly speaking, the rule of game, like the game is consistently changing due to a lot of factors, the macros. The recent rate is high, and it's kind of a hard time for private equities. And the AI bubble, not like a bubble, like the AI rush nowadays. People are putting a lot of money into AI. So there are a lot of factors that are constantly changing the entire landscape. But there's a rule of thumb for founders, and this is some of the suggestions I will always give to either my friends or my like entrepreneurial partners, my friends. Anyways, are you should either focus on product or how to build a product. These two things is
Mm-hmm.
the most important things. It's always product centric. It's always how you serve your user, understand their demand, and make them happy and make them buy your stuff and make them pay you. And this is typically something that early stage founders easily omit because they may found networking, socialing with other people, getting to know people, or spending time on researching. Like this, these are sometimes a waste of time, and you should really focus on products. And this is and including this and plusing, adding on what Lawrence just says. These are some essentials that will never change in this game. regardless how the market and landscape these changes, these are something that will never change. And what investor want to, because the game, like when we dive really deep into the industry, what investor wants to find is return, right? And how do you realize return is to gain capital, is to gain customers, and to make them buy your stuff. And how to make them buy your stuff, these are some basic simple rules that never changes. Just stick to this, and you will never be too bad.
Yes. Okay. So in this competitive market, how it is possible? Because if we look at the coffee brands, we will find 1,000 coffee brands, and all, like, still it's coming, right? So can you advise us that how to be different in this competitive market?
That's a good question. So there is a natural gap between the technical perspective of venture capital, and the say like the model or branding perspective of the venture capital. It is really great that, Haley, you found two completely different sector of investor today, because these segregates the to B and to C different business models, right? We, as a technical focused company, we do look into a lot of to B businesses, because for to B businesses, these technical, like these increase in the technical barriers and advancements may bring a lot of, like a huge margin for B side businesses, but it might be a completely different game for the to C businesses.
Mm-hmm.
And the example you brought up, the coffee shops, are actually to C businesses, and I don't, well, first, like, we don't really invest in coffee shops, so I have no idea how that works. But I guess Lawrence can add on a bit on this topic then.
Yeah, I think just generally from the experience we see, because in China, coffee was a really booming business. If you look at Shanghai, they got like 7,000 coffee shops, or 7,500. That's like number one coffee shop city right there, like surpassing New York, surpassing, all the cities, like just in 5 years, right? So it's crazy. If you come to our office, downstairs, that's like already 50 coffee shops. So it's a bunch, right? And I think really from the VC's perspective, first is we have to look at the business model, right? So if you are doing company owned model and you are looking for a lot of funding, that's probably not the right time right now, because it's so competed, so congested space. And if you're asking us to put money to open your shops, that use of fund is, I don't know, like that feels like we are the partners of the coffee brand. That doesn't make too much sense for the VCs to invest. But if you're doing a franchise model, the model itself should be cash flow positive, and then you focus on building very great supply chain, very consistent product quality, very nice, brand image. That's something we can look at, right? But ultimately, comes to your question. Now you have 1,000, brands, doing those franchise model. Who should I pick, right? I think from the VC's perspective, it's really, you have to. I mean, it's a hard game. It's a hard game. If you think about that in the PE's perspective, maybe you have more flexibility because you can do a couple consolidations and improve the operational efficiency, and you can generate more margins. But from the VC's perspectives, nowadays it's still pretty hard. Everybody can build up a central kitchen, build up a central factory. You can claim you do better on the supply chain. He can claim he's doing better on the brand. But and if you look at the numbers, some will definitely stand out, but that cannot converge it into one company that you're going to invest. So I think then that means for us it's a little bit challenging for us to pick. So really the idea is you probably need to pick it 5 years ago. because that's when the business just started. Everybody starts to scale up. Then you can find the guys that's doing the best operations, and the guy that's building all those things, right? And Luckin Coffee, has already done that. Last year, May, they have around 6,000 stores, but now they have like 16,000. So like 10,000 instantly new shops added in 1 year. So they're doing super great here. So if you're looking at franchise model, the first question would be, can they do better than Luckin? Because Luckin is a mix of company owned model plus franchise. Actually, mostly company owned model. So by comparing those, you can look at really if the company has that differentiation. Because I think Bill is talking about the barriers and all that, and for the 2C business, it's the same thing, right? If you can do better than the number one player, if you can challenge the incumbents, what's the point of investing, right? So I think it's a general question, but for coffee, you can really look at different things, and because you have the benchmark company, so you can really assess the possibility or the believability of the claims by the entrepreneurs that they can do better than Luckin, for instance. So that way is a good way to think about it. And also, yeah, I think you just mentioned about the differentiation. Right, so we are looking at an interesting company. We haven't closed it yet, so I can't talk about like really the details of it. But really, the guys are trying to innovate a really impressive alternative way of producing coffee because of the coffee shortage problems. And the traditional issue with those companies are their cost was huge. The commodity coffee price was like $3 to $4 per pound, after roasting and with the logistics, right? But these environmental solutions are generally like $60 per pound. And this company was doing even at a lower price with alternative materials with the same taste. So that's something you can really look at, because it sounds crazy, like, hey, are we really going to drink something that's not coffee but tastes like coffee, and you add caffeine into it? That sounds crazy, but really from there you can start to assess if it's worth investing. That's something really unique you can look at, and you can also look at the technical barriers of it and all those type of things. Right? So
that can be a differentiator point, right?
Yeah. Yes. But there are still many claim they can do the that alternative coffee, but the real one should have great traction. The real one should have sales. The real one should have the cost being the first factor instead of just marketing for sustainability. So that way I think it's the right way to start to evaluate those businesses.
As right now we are talking about claims, my next question would be that what is your new, what are the factors you look before you invest? So how that process looks like with you?
Yeah, maybe I can talk about it first. I think as a VC person, venture capitalist, you will start to realize that the business model, the real business model of a lot of startups are making money from VCs. I'm not kidding. Like, they are making money from VCs. So they get the money, they burn the money, and then if it failed, they go for the next project. Really, a lot of companies you will be seeing are making money from VCs. So that's actually funny, but that's actually real for a lot of projects. So as VCs, our goal is to protect ourselves to not be, taken advantage of by those companies, right? So our way, is really, you have to come up or come into the meeting with the perfect, balance of, humility, so that you can balance your audacity, right? So, you gotta, because you've been meeting with many companies in that field. and you have some domain knowledge, and you know some things can be achieved. But you
Mm.
really gotta be very, humble to assess the idea, and potentially that one can be the one that's right there. It can change the game, right? But even though the others can't. But you also need to be very curious. You know, that way you are not listening to the founders because everything is claimed. They will say they have the best team available in the market. They will say they have the best product available in the market. They will say, they have the best execution in the market. They will say their customers are so loyal, their customers are so vocal. They can make all the claims, but that's understandable, right? Because unless it's your grandpa or grandma, nobody will claw back there and, shout out for you, right? So you have to shout it out for yourself. But as VCs, we really gotta, verify all the points they're talking. If they say they are the best they have the best technology in addressing this, so show me some evidence. But we also will do, due diligence. We can talk with other similar companies. Are you the only one that can do this? Right? Is there any patents we can view? Is there anything we can, assess? Third-party reports. All the due diligence and expert interviews can help us to identify whether or not your claim is true or not. And if, once we identify so every time they put a claim, we put a question mark. And if we verify all the question marks, I think, we can really say that the founder seems credible and the team is incredible. So, maybe we can move forward to look at other aspects, right? So that way, I think being curious instead of just believing it will help you be well, will equip you pretty well to protect you against all those like making money from VC type of thing, right? And also, you got to be, humble to learn those ideas. So that's my, quick couple lines on this. Yeah.
Yeah. What do you think, Bill?
Lawrence covered a lot of it. My add-on to that is, as venture capitalists, you gotta keep your objectivity and constantly challenge your views. Objectivity, that is really easy to understand. Don't bring any subjectiveness during the due diligence process. Don't fall in love with your project manager, right? Don't fall in love with the founders. Um, Try to keep facts as facts and emotions as emotions. That's objectivity. And I found the second part, constantly challenging yourself, really important, at least to me, is when there is a tiny ambiguity, you must to mark the question mark, as Lawrence just said. Put the question mark there and ask yourself why. And constantly asking why will really help you build a more comprehensive profile of this project. In that case, um, if you can't even solve all these question marks, why would you let it pass the investment committee? There's no point of putting money into that project if you have a lot of question marks. It is only until you're first to maintain this constantly challenging yourself model and to solve all the challenges you had that you and your team can be convinced to invest in this opportunity, right? So objectivity and constantly challenging is two of the most important aspects I figured out in this process.
The next question will be very similar to the question you have answered, that what advice will you give to the founders who are going to pitch to investors? So what are the factors they need to be very careful, and what is your advice for them?
I guess I can take the role for now. Biggest advice is honesty. Founders are human, like investors are human. We know what stage you're in. And if you're a student and you're bringing this product from a lab, then we know that you're probably not making any money right now, right? Just don't brag and fake things up. I mean, there is a saying, fake it till you make it, but just be honest. And we will take care of everything else. We will do the due diligence and we will interview you and get facts from you and from others. And honesty is the rule of thumb. And second, some advice that I recommend founders to do is to, again, build products. focus on the products and focus on acquiring new customers and check their willingness to pay. These figures are particularly important in nowadays because, as I said, not the bubbles, it's a quite hard time for ventures, at least in the US for us. And we're a bit tighter than last year and the year before. And we do want to see a lot of factual figures to convince us to put money in your project, right?
Mhm.
Yeah, that's something that I will put emphasis on.
Is ever happened to you that the product is good, but you like to take a bet on on the founder? You feel that founder is so confident and it looks like he will gonna do something. So do you like to take a bet on investors? Sometimes you think that product is not that much great, but you can, like, your team can improve the product, or he has ability to improve the product, and you like to take a bet on founder. Ever is it happen ever?
So there are basically products and founders, right? And there are four scenarios. Product sucks, founder sucks, then big sucks. Product good, founder good, then big yes. If product is good and founder is bad, or product is bad, founder is good. Let's talk about the first case. If product is bad, founder is good, then for us, this is something we won't proceed on because we are focusing in the technology. If the technology is bad, we don't believe in a lot of technical barriers. We don't believe it can be sold to others, even if the founder is a extremely good salesperson, and know how to brand himself. But we don't really believe in that. But vice versa, we believe our help and our network in the industry can help their product getting a boost. Although the founder's profile is important as well, their personality is important as well, but it's not as important to us as a product.
Mm-hmm.
Right?
Makes sense. What is your view, Lawrence, on this?
Which one? The
On the
founder
first,
part? The
on the
first
first,
part.
yeah,
So like recommendations for the founders.
yes. So, like, what is your advice, first of all, to entrepreneurs when they go and ask to investors, they pitch to investors? What is your advice for them
Yeah, for
first?
the pitching itself, it comes down to the pitching itself. I think really, is to focus on, like, of course, I totally agree with Bill. It's, you gotta be really authentic, right? But also, I think it's just focused on the business, right? Like, sometimes they are so into their stories. You know, yeah, I saw you're laughing, so you probably know what I'm talking. Like, they're so into their stories that they don't have any specificity on how they realize it, right? And really, the oftentimes great ideas has a weird story, like the beginning of the story, and the most important part is how you navigate through that maze, right? If you think about Airbnb, it's weird. Like
Hmm.
like renting your home for some strangers. That sounds weird. And it's not a fantastic story, or fancy story, right? But the way is, really the key is to navigate the investors throughout the, how you achieve it. And that's the most part people should focus on. Like, what are the numbers? Why it can't be done by others? Why it hasn't been done by the incumbents, right? What's your value prop? What's your execution? Why it's so special that nobody can copy you? Why it's so special that your solution is, in the short term or medium term, the only solution? And that's the key for you to, navigate us through the maze, instead of just saying, hey, imagine if I can get those customers, I can generate 100 million sales. But come on, dude, to be honest, you haven't been there yet, and imagining success wouldn't be really helpful, right? And really, it's your plan. And also, sometimes people go to the opposite, right? They talk about so much about the operations. Like, I was in chat with the company. They were doing some like online community type of thing. And he's like really focusing on the techniques to acquire the customers. and losing the big picture. However, we need to know, okay, let's assume you succeed with all that and you have all those clients, like what's the value you can create? And oftentimes that's where the connection is lost, because the guy is so into, making their, communities better, but losing the big picture, like of the dream state, right? Oftentimes that happens a lot to the tech founders, right? Many tech founders really just want to be, to winning the next Nobel Prize. They don't care about making money. They don't care about the market size. Like they just want to do research, and that way they are like so into how we do the research, but ignored what you're actually doing, right? So both extremes should be avoided, I think, throughout the pitch. Although, for the technical founders, it's more tolerant because, you can have the guy doing tech part really well, and, you can have a business guy to help you navigate through all the, sales and marketing. But generally, I would say just focus on how do you get there instead of what is it, or, instead of, your technology, or really tiny details that investors wouldn't care at the beginning.
True. So, how do you assess scalability and growth potential for business before making an investment?
Yeah, I guess I touched base on that a little bit. Like it's the
Yeah.
product market fit, right? It's really, you have to have a good market. So the business model of VC, if you think about it, the expected return is really the probability times your successful exit, plus the, probability that you don't succeed, which is 1 minus the productivity of your successful exits times 0. So it's generally like that. So, so to succeed in general, you have, if you are like having 10% chances to have really successful exit, right? Meaning your P is 0.1. So to get your money back for your whole funds, if you're investing in, 20 companies, you gotta have, literally each company should have a really high expected rate of return. They should have at least 15 or 20x to make your fund making money. Otherwise, you can't sustain. So we really, the market should be really strong. The market always comes first, right? You can build up really fancy technology. Let's say you can get people to, outside of the Milky Way in 1 second. That's something that's really fancy. But you don't have a market. Nobody needs to go there, right? So really, you have to have the market, right? And the market, if it's huge, even though you can take only 10% of it, it's $1 billion company. Then we have that, the 20x or 15x expected return. Then that qualifies for the VC investment. Otherwise, you can't do it. So we really, every time we talk with a company, one thing we really need to assess is if the dream state is achieved, can it generate like 15x or 20x for us? If not, like if it's at most 5x and you invest 10 of them, your fund is going to be really performed poorly, because the failure rate is so high. If you think about all the investments in Silicon Valley, on all those tech investments, among all the 4,000 startups that's looking for funding every year, or maybe 5,000, only 200 of it will get invested by top VCs, but only 15 or 20 of it will generate 95% of the profits for VCs. So you really need to hit those to get your fund really successful. So, so we really need to assess the market should be really huge. And that way you have the scalability. Then you can look at the unit economy model, like what's the growth factor, right? If your business model is number of people times the average revenue per user, the ARP, then you really need to assess, can you scale the number of people? Can you scale the number of average revenue per person, right? If you can't, or you can only do that in one, one aspect, then you really need to assess, the possibility of, success. So that way you can assess the scalability, but always market comes first.
So true.
Yeah, that's my quick lines on those.
Yeah. What's your thoughts, Will?
Definitely agree on markets comes first, because if there's no market, how comes scalability? You can't scale at all because there's no one is gonna need your
Yeah.
stuff, right? So market definitely comes first. And yeah, and in terms of the Lawrence made a really good point on using the formula of impact and what is that called? The probability and impact. The multiply of them equals the expected outcome of VC, right? But I would also add a factor, I mean a dimension of time, because time sometimes is really important in the VC industry as well. Because when you look into the story of say like Nvidia. Now, Nvidia is too huge. Look at the story of whatever AI, SoundHound or Alphabet, not Alphabet, what's character AI. These are ventures that really grab the right time. The timing is really important as well.
Yeah.
And when it comes to the success rate on the return rate, definitely agree with Lawrence again. 25x or 16x. So there is a really so when it comes to this, I would like to make a really good analysis because analogy, because we are saying that we claim that our thesis is the focusing on the minority founders in the East Coast, right? Because we have found this really successful mode in the West Coast already. There's a fund called TSVC, and they are making a unicorn rate of 100 to 8. That is about 8% of their unicorn rate, which is really impressive. Meaning that they only need to target of a 12x unicorn return. If that can like just balance out all their debts already, which means that like this is a huge number already. And if this works in the West Coast, why not in the East Coast? Since the East Coast is you have all the tech people here, like in a very beginning stage, like before they moved to the Silicon Valley. Okay, we invested in a lot of projects in Massachusetts, but eventually they all moved to the Silicon Valley. But still, we are the first round investors. Well, anyways,
Yeah.
these are how to scale as a VC, and I've touched a bit on the very beginning, like how to scale as a founder. You really need to find a market and find a good product market fit first.
Mm-hmm. And what role does mentorship and guidance play in your investment strategy?
This is a great question. This actually is a question that we usually ask the entrepreneurs. What do you expect from us other than money? And most of them will say nothing else. Just give us a check. Just write the check for us. And for these kind of answers, that's gonna be a kind of like a small red flag for us, because we do want to have our founders ask more from us, because we want to provide more because it's our money, and if we invest in your equity, if invest in your project, then we have equity on it. And second, uh, we do have connections that can help you, that can empower you to scale, right? So I mean, our fund typically, definitely, again, is totally different from Lawrence Fund, because we have a lot of connections in the first academia,
Mm-hmm.
and second the minorities in culture, and these connections may help them to get more clients, more advisors, and better technical barriers and better understanding on their products. These are something that we can help them on. We're not like PEs that can help different projects to merge together, because we don't have that kind of size of portfolio, but we do have a lot of connections other than funds that can definitely help scale our portfolios.
Mm-hmm.
Yeah,
Yeah.
I
Yeah.
think similarly, Bill made a great point. You have those expert networks, and you can really help them grow. And I guess that's the same thing works here, right? So we are very well connected with all the multinational companies. All our LPs are multinational companies. So we also have very extensive, expert network, and also, the mentors, advisors, etc. However, though, it's a tricky question, right? Oftentimes, great founders don't need like that much of help, because if they rely on you, you should question yourself, right? Like, am I looking at the right guy? Because he gotta have his own networks. For instance, he gotta be able to handle like 70-80% of the problems, and then he needs something that out of his reach, they can come to us, right? We shouldn't take
Mm-hmm.
100%. So that's the way we look at it. And also, there's like the stubborn role in VC, what I call, like, the founders should be somehow stubborn, right? If you ask them, have you thought about this? Have you thought about that? Do you want to try this because we can provide X? Have you want to try that because we can provide Y? You know, really, that's a little bit weird, because if he has thought about what he should do and how to play the game, he shouldn't be easily changed by you. So that's actually a question we often ask during the pitches. Like, have you thought about doing that? That sounds interesting. And oftentimes, weak CEOs will generally say, I'm not saying absolute, but generally they will be very agreeable to your proposal, whereas strong CEOs oftentimes say, that probably can work, or that can work, but maybe not the best solution at the moment, because they have still experienced in the field. They know how to do it, and that way, they can build up their excellent products right now, right? Or service. So I think, in terms of the original question, the guidance and mentorship, I think it's we should be in the minor role, I would say, because really,
Yeah.
he has to, has his plan stand out, and we can help. We are sort of the plug, right? If he needs it, we can plug it in, but he shouldn't be fully dependent on us.
Yeah. So true. So we only have 5 minutes left. If anybody wants to ask questions, they can put in the chat box and we can take the questions. And if not, I have a final question for both of you, that what will be the advice for the founders, basically, because as I told you earlier, that in Northeastern we have a lot of entrepreneurs and there are a lot of undergrads who are starting their business. So do you have any final advice for them who is starting their own business?
Go ahead, Bill.
No, you can go ahead. Sorry.
No, I think we talked a lot about the advice for founders. Hopefully, we can we can compile a book on that. But probably it's a really thick book, because generally it's pretty hard. I think, again, there's no right way from my perspective, but really, wrong ways to do it. So I think, just reiterate, right? Just practice perseverance, and also do things that you really have passion about, so that you can persevere, and so that you have that sense of genius, so that you can make your impact in the field. Don't really start up a business because that's some sort of hot field. For example, the current buzzword is AI. Like, it's something that's not even related to AI will claim they have AI, but that used to be metaverse, that used to be, the mobile network, that used to be a lot of things. So don't chase hot fields for making money, but really things you're passionate about, and then you have the passion, you have the enthusiasm, so you can persevere. You can be there so long, you can wait for 10 years to succeed, to make your impact. So I guess that's my general advice.
Yes. What's your advice, Bill?
Yeah, enthusiasm is the most important. You need to really love what you're working on. Otherwise, just imagine if you're not getting money for a year and you can't step out of your room for a year. Are you still willing to work on this for this entire year? If the answer is yes, then go for it. If it's no, then have a second thought.
Okay. Thank you so much, Bill and Lawrence, for your valuable time. Thank you so much, audience. Okay, this will be available on our YouTube channel, Northeastern Alumni YouTube channel, if you want to share with your friends. And yes, thank you so much for everyone for connecting, and have a great rest of your day.